Welcome back to the podcast. I'm Jenny.
And I'm Mark. And today, Jenny, we have some information about a big player in the financial world making a significant move in the tech-driven insurance space. We're talking about Edmond D.E. Rothschild holding SA and their recent increase in shares in CCC Intelligent Solutions, or CCCS as they're often called. Now, this isn't just a small purchase. It's quite a statement, feels like.
A statement indeed. It looks like they increased their stake by a substantial 66.9%. That means they added another 2.49 million shares, bringing their total holding to over 6.2 million shares. And at the current market value, that's worth around $73 million. That's a serious amount of money to put into one company, especially right now.
Right? And it's not just a casual addition. This move makes CCCS their 16th largest holding overall. When a firm like Rothschild shows this level of commitment to a company, it definitely makes you wonder what they see there. Especially in a sector that's transforming rapidly thanks to technology, you know?
Exactly. It signals a certain confidence, doesn't it? But what's fascinating is that while you have big institutions like Rothschild buying in, you're also seeing some other dynamics at play within CCCS's ownership structure. I was looking into it, and something like 95% of the company is owned by hedge funds. That's a high concentration, isn't it?
Oh man, yes. 95% owned by hedge funds? That's a lot of sharp elbows in one room, for sure. It can definitely affect how a company is run and how its stock behaves. Hedge funds frequently look for quicker returns, or are more active in pushing for changes. But, this isn't the whole story here, is it? Because we're also seeing some insider activity that seems to go in the opposite direction.
This is where it gets truly interesting and, frankly, a little confusing. While institutions like Rothschild and others are increasing their positions, I saw that both Norges Bank and JP Morgan also upped their stakes recently. You have significant insider selling happening at the same time. The research shows that Eric Way, an insider, sold a massive portion of his shares. We're talking over 42 million shares, valued at something like $434 million, over just the last 3 months.
Okay, wait. Let me make sure I understand this. Big, long-term focused institutions are increasing their holdings, seeing value and potential. Meanwhile, someone times inside times the company is selling off almost everything. That feels like a significant disconnect, doesn't it? What could explain that? Is it a lack of confidence from the insider? Or something else?
That's the substantial question, isn't it? On the surface, insider selling can look like a red flag. If the people closest to the company are selling, maybe they don't see a bright future. However, it's not always that simple. There could be personal financial reasons, portfolio diversification, needing liquidity, that sort of thing. Given the stock performance has been a bit down recently, maybe it was a strategic personal move, not necessarily tied to a lack of belief in the company's fundamentals. But it definitely invites questions, especially when contrasted with the institutional buying.
For sure. It's like, who do you find more credible in that scenario? The seasoned institutional investors doing deep dives into the business model? Or the insider who might have more personal reasons influencing their decisions? And to understand what those institutions might be excited about, we need to look at what CCC Intelligent Solutions actually does. From what I gather, they're deep in the AI-driven side of the insurance business, right?
Yes, certainly. Their focus is on leveraging AI and a cloud-based SaaS platform to connect all the players in the insurance ecosystem. Insurers, repair shops, lenders, and so on. They're creating a more streamlined and efficient workflow for things like claims processing. And they're particularly looking at expanding into markets like China, which is undergoing substantial digital transformation, including in the insurance sector.
Oh man, this is a great part. AI and insurance. It sounds a bit dry, maybe, but think about the potential impact. Claims processing, damage assessment, fraud detection. These are all areas where AI can bring real efficiencies, and China is a substantial market with a rapidly growing insurance industry. If CCCS can establish a strong foothold there with their AI platform, that could be a significant growth driver. So maybe Rothschild sees the long-term potential of this AI-driven approach and their strategic positioning in key markets.
That makes sense from a growth perspective. But then you have to look at the valuation. The stock performance has been a little shaky, and the financial metrics are, Noteworthy. The company has a PE ratio of 446. Now, even for a tech company, that's quite high compared to the industry average, which is closer to 30.
Okay, hold up. Can we break that down for our listeners? A PE ratio of 446? That means investors are willing to pay 446 times the company's annual earnings per share for the stock price. That is a premium. A noteworthy premium. It suggests that the market has very, very high expectations for future earnings growth, wouldn't you say?
Precisely. And that high valuation is likely why you're seeing some mixed signals from analysts. While the overall consensus is a moderate buy, with an average price target of $13, which is actually a bit below the current price, interestingly, some firms are getting a little more cautious. Piper Sandler, for example, recently downgraded them to neutral, citing valuation concerns and near-term headwinds.
So, even the experts are kind of split, it seems. Some see the underlying business and its potential, especially with the AI angle and market expansion. Others are looking at that PE ratio and saying, hold on a minute. The price might be a bit ahead of itself right now. It creates a fascinating picture for investors trying to figure out what to do with this stock.
It truly does. And to add another layer to this, the company recently announced a stock buyback program. They've authorized up to $300 million for share repurchases, which is about 4% of their outstanding shares. What do you make of that in this context, Mark?
A buyback. That's usually a signal from management that they believe their stock is undervalued. They think the market isn't recognizing the true worth of the company, so they're using their cash to buy back shares, which can reduce the number of outstanding shares and potentially boost the stock price. It's like them saying, we think our own stock is a good investment right now, right?
But again, is it advisable with that PE ratio at 446? Are they truly undervalued? Or are they just trying to bolster a stock that's already trading at a significant premium? It makes you wonder about the effectiveness of the buyback at such a valuation, doesn't it?
That's the tension right there. Management seems to think there's value there, enough to invest their own cash into buying shares back. And institutions like Rothschild are also acting on that belief, adding significantly to their positions. But the market, overall, and some analysts, are expressing caution due to the valuation. This is where it gets tricky for investors. You have these different signals vying for your attention.
So you have a respected financial institution notably increasing their stake in a company focused on AI in the insurance space, particularly in growing international markets. But then you have high insider selling and a considerably high valuation, leading to mixed analyst opinions. It's a complex picture, for sure.
It certainly is. And it highlights that you can't just look at one signal when you're researching a company. You have to zoom out and look at institutional ownership, insider activity, company fundamentals, market position, and analyst sentiment. CCCS has some promising aspects, especially their tech and market focus, but the valuation and insider selling definitely add layers of complexity that warrant a close look. Wouldn't you agree?
Certainly. It's something for our listeners to consider as they do their own research. It's a prime example of how different pieces of information can paint a truly nuanced, and sometimes conflicting, picture of a company.
Precisely. And it just goes to show how interesting the world of finance and technology is right now. There's frequently something new happening, always a new puzzle to solve. Thanks for diving into this one with me, Jenny.
Always a pleasure, Mark. And thanks to our listeners for joining us. We could ask our listeners, what do you think is the most significant factor influencing CCC Intelligent Solutions stock performance? Increased institutional investment, insider selling, or the company's AI-driven strategy? Let us know on our social media. We'll be back next time with another fascinating topic.
See you then.